If you're like me, you may have heard assets throughout your life that sound cool to invest in, but you just have no idea how to invest into them. For a while, that's how I was with REITs. I had no idea what platform to use, what REITs to invest into, etc. But now that I've learned more about investing, I've realized that everything you ever want to invest into is literally just a ticker symbol. That's it. You want to invest into gold? Ticker symbol. S&P 500? Ticker symbol. Bonds? Ticker symbol. And in this case, REITs? Ticker symbol. But what is a REIT? By definition, a REIT is a company that owns, operates, or finances income producing real estate, and it allows you to get exposure into real estate without having to put down a bunch of money for like a house or something. REITs work by allowing you to pool your money with other people into a company that owns real estate and leases to businesses that generate a lot of rental income. Mostly commercial businesses, like a hotel, for example. Because of all this rental income, they're able to pay out a lot of money in the form of dividends, and they're actually required by law to pay out 90% of their taxable income, and some even pay out 100%, often leading to high dividend yields. I'll talk about how to analyze REITs in a bit, but first I'd like to talk about pros and cons because there are many reasons someone may want to invest into a REIT. For starters, it creates a more diversified portfolio and just gets you into real estate, kind of the point of this whole video. But specifically, since real estate quite often holds or even raises in value during inflationary periods, it's a great hedge against inflation. On top of that, it's way more liquid than a house. Have you ever tried selling a house? Often it takes months, but even the absolute fastest transactions will take days or weeks. With REITs, you don't have that problem. You literally just click sell and it's over. But you combine this with usually a high dividend yield, and you have a pretty solid combo, especially if you're a bit older and or closer to retirement. Realty Income, ticker symbol O, is a REIT that a lot of people have money in, myself included, and right now it has a dividend yield of 5.6%. That's higher than just about every high yield savings account as well as bonds by a significant margin. Now, this all sounds good, but there are some cons when it comes to REITs, as with anything. These most notably are tax inefficiencies and sensitivity. Let's start with taxes, everyone's least favorite topic when it comes to money. A REIT isn't considered a qualified dividend, and it's taxed as ordinary income, which means you'll be paying a lot more in taxes on your dividends. If you don't know what a qualified dividend is, basically, when a company meets certain IRS requirements, their dividend can be taxed as a capital gain instead of ordinary income, and the absolute maximum tax you can pay on capital gains is 20%. Now, earlier I mentioned sensitivity. When I say sensitivity, there are two different things I'm talking about: interest rate sensitivity and sector sensitivity. A lot of times, REITs will use significant debt to purchase real estate, and when interest rates rise, that debt is going to be even more expensive. On top of that, if borrowing and spending is more expensive, then people aren't going to borrow and spend as much, which potentially could lead to your REIT making less money. This is a double-edged sword, though, and you could use it to your advantage, and I'll actually show you an example later in the video. But if you're expecting rate cuts, it can make REITs way more attractive, and whenever cuts finally come, your REIT can start performing really well. But that leads me to sector sensitivity. There are so many different sectors a REIT can be in. There are industrial REITs, retail REITs, residential REITs, but let's just say hypothetically, you had a bunch of money in residential REITs during the 2008 housing market crash. You wouldn't be doing so good. There's not much else to say about that. I just wanted to make sure you were aware of it. So do what you will with all that information, but now I'd like to showcase some to you and talk about how to analyze them because it's a bit different than a regular stock. With REITs, you can't just look at their net income, it just doesn't make sense. In fact, Investopedia flat out says earnings per share and price to earnings ratios aren't reliable ways to evaluate. But the reason you can't do this is because it doesn't take into account crucial metrics for REITs, specifically their depreciation and amortization. Instead, you want to be looking at FFO, or funds from operation, and or AFFO, or adjusted funds from operation. I've used ChatGPT to help me research this video, and I'll give you some of its definitions and examples for these. So it actually gives FFO as an equation, and kind of like I just said from earlier, it's their net income plus depreciation and amortization, but also minus their gains on the sale of a property. But FFO allows you to see a clearer picture of how well a REIT's properties are generating income, and it helps gauge if their dividends are sustainable. They also gave an example, and I'll put it up on the screen. But if a REIT has a net income of 50 million, depreciation of 20 million, and 10 million on a property sale, then you add up 50 and 20, subtract the 10 from the sale, and so their FFO is 60 million. It also gave AFFO as an equation, which is just FFO minus capital expenditures, straight line rent adjustments, and then plus or minus other adjustments. But AFFO tends to be a little more accurate in terms of like dividend sustainability, and some people even use price to AFFO as a valuation tool, kind of like PE ratio, but just for REITs. And ChatGPT gives us this cool example. It says, think of it this way: FFO is a real estate company's operating performance, and AFFO is what's really left in the bank after keeping the buildings running. I know I probably shouldn't be using ChatGPT whenever I have money invested into Google, but it helps save me some time. But now, for the moment you've actually been waiting for, what are some REIT recommendations? I mentioned Realty Income earlier, and I actually own them personally. They are a retail REIT, and their top 5 holdings are 7-Eleven, Dollar General, Walgreens, Dollar Tree and Family Dollar, and EG Group Limited. I'm looking at their annual operating income since 2015, and it's been consistently rising every single year. And in 2024, it was up over 20% year over year. I know that only goes back to 2020, but that was on my computer. On my phone, I can see back to 2015. Just like you have to look at FFO and AFFO instead of income, you also have to use that when looking at payout ratios. REITs have to pay out 90% of their taxable income, but not 90% of their AFFO. According to Seeking Alpha, their AFFO payout ratio is about 75%, which is on the higher side, but they've been consistently growing their AFFO and their dividends for years. They actually increased their dividends quarterly, and in December 2024, they increased their dividends consecutively for the 109th time since 1994. Their debt-to-asset ratio is up 1.3% year over year in 2024, but they're only sitting at 43% debt to asset. Overall, Realty Income is super famous in the REIT community for a good reason, and what's super cool about them is they actually pay dividends monthly. So the next one I actually found on a Seeking Alpha article, like just now as I was making this video, but it piqued my interest. And so all of this analysis was done by a guy named Jussi Escola. I hope I pronounced his name correctly one of those times, but credit to him. But anyways, this REIT is Canadian Net REIT, ticker symbol CNNRF. This guy compares this one to Realty Income a lot, but this one is also a monthly dividend REIT, and he said the yield was 6.7%, which as of this video is slightly outdated, but right now it's sitting at 6.3%, which is still really high. And he also says their payout ratio is 55%. That's really solid. I will say I wasn't able to find this metric on Seeking Alpha. It literally just wasn't filled in for whatever reason. So I can't personally say how accurate that is. And I don't know if it's like the core AFFO or just, my bad, core FFO or the AFFO. But that's what he claims. But he brings up Realty Income a lot and shows that they have a lot of similar properties, such as quote-unquote quick service restaurants, convenience stores, and grocery stores. But because this REIT has 2 times the exposure to investment-grade tenants, there's a much lower chance of lease delinquencies. And it's actually a pretty small company. Their portfolio is only $335 million. I know that sounds like stupid, but it's actually a small portfolio. So pretty much every acquisition they do right now results in a lot of growth. And he shows a chart from 2013 to 2023, which might be some slight cherry picking. but their FFO has CAGRed about 16%, which apparently is 3 times faster than realty income. But the last thing he mentions is Canada's rate cuts. Canada has been pretty aggressive in cutting rates, and they're already 100 basis points lower than the US and expected to keep declining pretty rapidly throughout the rest of the year. I thought that was cool because, I accidentally found an example of someone using the strategy I was literally talking about earlier with the interest rates. But I've kept you here long enough, so I'll try to be quick with this last one. It's Vici Properties, ticker symbol VICI. I also own some of them in my portfolio, but they have a bunch of properties on the Las Vegas Strip. And, Las Vegas has been growing so rapidly. So when I heard this, I was even more interested in buying shares. But just a quick look into their financials, their debt to asset is down 2.1% in the most recent quarter, and it's sitting at 40.64%. Their core FFO is up 8.85% year over year in the most recent quarter. And if we look at the numbers annually, they've seen consistent growth since 2018 and have seen rapid growth from 2021 to 2022. If you see this, it's crazy. I'll put a chart on the screen actually. Their AFFO payout ratio is almost 75%, which it is up there, but as we've seen with realty income, it's not something to freak out about entirely. Like they can maintain it. From what I've seen, REITs don't typically raise their dividends by a high percentage, but Vici Properties has been paying and raising their dividends for the past 6 years with a 5-year CAGR of 7.73% and a 3-year CAGR of 6.69%, which is actually some of the highest I've seen from a REIT and still outpaces out inflation. REITs can be a powerful tool to add to your portfolio, especially if you're a bit closer to retirement. Always remember, do your own research. This is not investment advice, but this has been my longest video, and I hope you got something out of it. Feel free to leave a comment. I love interacting with them, and good luck on your investment journey.